Hello and welcome. My name is Loraine Martinez Bellamy. I'm an attorney at the Connecticut Fair Housing Center, and today we're going to be discussing your post-forbearance options if you have a USDA loan, either direct or guaranteed by the USDA. If you are unfamiliar, the COVID-19 forbearance is a temporary pause or reduction of your monthly mortgage payment available to borrowers with pandemic-related financial hardships. The USDA forbearances are available until the end of the national emergency. Currently, that's October 15th of 2022, but it's likely to be extended through 2023. The term of the forbearance is 6 months of an initial forbearance and 6 months additional period available upon request for a total of 12 months. So if you have not needed a forbearance, but you do now, they are still available at least until October 15th of 2022, and maybe even available afterward, depending on when the national emergency is declared to have ended. The options we're going to be discussing first relate to USDA guaranteed loans. And in order to determine whether you have a guaranteed or a direct loan or a USDA loan at all, you would want to contact your servicer. That is usually the easiest way to get the information that you're looking for. So option number one, post-forbearance. So your forbearance has now ended. Maybe you've gotten the maximum amount available and you're trying to figure out what to do moving forward. The first option is a repayment plan. This is available or best for borrowers who can afford their old payment. So you're not looking for any term changes or any reduction in payment. You can afford your old payment and you can afford to pay back extra every month in order to pay down the months that you missed. Your servicer will determine the total arrears due and spread those additional payments over a certain amount of months. So say you missed only 3 payments during the pandemic and we're only in a forbearance for 3 to 6 months, maybe your repayment plan will only be a year or a year and a half long. If you ended up doing 12 months of a forbearance, the repayment plan may be longer, but you will discuss that with your servicer and it will be available to you in writing. The details of the repayment plan will be provided to you in writing and you will have to agree to it. It'll also be monitored monthly by the servicer. So if you've informally been sending extra payments in hopes of catching up, I would suggest that you contact your servicer and get a formal repayment plan on the books in order to protect yourself from any miscommunication, which could lead to a foreclosure. Post-forbearance option number 2 is a deferment. A deferment takes your outstanding payments and places it at the back of your loan. It will show up on your statement as a deferred principal balance. This is available to borrowers who can afford their old pre-hardship mortgage payment but can't afford to pay the arrearage. So you're happy with your old payment, you just don't have the other payments available to reinstate it completely right now. In order to qualify for the deferment, you would have had to be 120 days or less past due on March 1st of 2020, or maybe you bought your home or originated your loan after March 1st, 2020. The deferred amount must be paid by your loan maturity date when your property is sold or any time the loan is paid in full, for example, in the case of refinancing. So you don't have to worry about this deferred amount at all. If your intention is just to stay in the house and continue making your mortgage payments, it will come into play if you decide to sell the home, refinance, or your maturity date comes up. Post-forbearance option number 3 is the COVID-19 modification. This is a combination of a loan modification and a partial claim or refund. And I will explain this in detail. It's available to borrowers who cannot afford their old pre-hardship mortgage payments. So you're looking for term changes. You're looking for a reduced interest rate, for your maturity date to be extended further to allow you more time to pay it off. And again, you would have had to be current or less than 120 days late on March 1st, 2020. So in this case, the servicer is targeting a 20% reduction in P&I payment, and it'll do that or attempt to do that by adding your outstanding payments to your current principal balance, reducing the interest rate. USDA sets its own rate, and it's usually less than market rate, but your servicer will be able to provide you that information. It'll extend the term of the loan by 30 years. And if necessary, if it has still not reached that 20% reduction in just the principal and interest payment portion of your monthly mortgage payment, Then it'll implement a mortgage recovery advance, or an MRA. And what this is up to 30% of the unpaid principal balance as of the date of the default can be taken and kind of placed again to the end of the mortgage into a silent second mortgage. And what the servicer will do is it will send a claim to USDA saying, we'd like you to pay this mortgage down by up to 30% in order to make this person's payment more affordable. And the way that it does that is because you are now paying less interest, because you are paying interest on a lesser principal balance. So a little confusing and technical, but it's a step that's implemented only if necessary, and it reduces the amount of principal you're paying interest on. A trial modification isn't required for this option, and the MRA just has to be paid by the existing loan maturity date when you sell your house, or anytime the loan is refinanced or paid off in full. So again, the same thing, you don't have to worry about it at all or make payments on it until you decide to do one of those things. And so these are the options for USDA direct loans. Again, you may know this, you may remember this from your closing, but if you do not, you want to contact your servicer and find out whether your loan is direct or guaranteed so you understand the options available to you. So for direct loans, it's a standard loan modification available. The servicer will add the outstanding arrears to the current unpaid principal balance and re-amortize the mortgage. So you will have a new principal balance, a higher one. The terms of the mortgage, so your interest rate and your maturity date, will remain the same, and the loan will be brought current, and the borrower will be notified of a new mortgage payment. So nothing changes. They just throw the payments you're behind on back into the principal balance, and you have a new payment and you're current and you move forward. If you can't afford that, or if for some reason it's too much, you can also access the American Rescue Plan refinance option. This is available until September 20th of 2023. And it's meant to provide the borrower with an affordable mortgage payment. So there are income limitations. So you have to have adjusted household income at or below moderate income limits for the area. And I've linked the USDA website here that will help you determine whether you qualify or not for this one. And this is meant for borrowers who were approved for COVID-19 forbearance or who have experienced financial hardship related to the pandemic, whether or not you called and said you wanted a forbearance. So in this case, for this refinancing option, your arrears will be again added to the unpaid principal balance. Your interest rate will be reduced. The rate will vary, but it's currently 3.5. So the interest rate available for USDA direct loans is much lower than market and is just determined by the USDA. They do their own thing in terms of interest rate. The term of the loan will be extended up to 38 years if needed to meet affordability requirements that the USDA has. And your closing costs, because it is a refinancing of the mortgage, there will be closing costs, but those can be rolled into the new loan. So you shouldn't have to bring any cash to the table in order to access this option. It's not subject to credit analysis or other underwriting beyond affordability assessment, which you'll be able to discuss in detail with your mortgage servicer. So My Home CT is a pandemic relief program. This is a post-forbearance option available for both guaranteed and direct loans. So you can tap into it and receive up to $50,000 in grant assistance to pay out outstanding mortgage payments, property taxes or homeowners insurance, water, sewer, or other utility bills, condo common charges or special assessments, or fees and costs advanced by a servicer on a reverse mortgage. So the beauty of the My Home CT program is that it's grant assistance, so it's essentially free money. But not only that, but you can come current on your mortgage and clear some of the other debts that may have accrued while you were out of work or underemployed during the pandemic. So things like your water sewer bill and other utility bill, condo common charges. When you apply for the program, they will ask you if you are behind on any of the qualified delinquencies that you can receive assistance for. Your financial hardship will have had to occur between October 2019 and present day. There is that additional cushion added to the beginning of the pandemic because the program administrators realized that it's possible that folks fell behind in the fall of 2019 and had every opportunity and intention to come current on these housing expenses and did not expect to lose their jobs during the pandemic or to have hours reduced. So there is some grace there in terms of when the hardship would have had to begin in order to be eligible for the program. Your property has to be your primary residence and it has to be a 1 to 4 unit home. Your household income also must be equal or less to 150% of area median income. And I've linked the map that CHFA has provided to determine what area median income is in your town, so you can see if you qualify. If your mortgage arrearage exceeds the program maximum of $50,000, you can still apply for My Home CT and combine the grant funds with one of the loss mitigation options I discussed before. You just have to make sure you apply for My Home CT first. If you bring your loan current with any of the loss mit options provided by the USDA through your servicer, you may not qualify for grant assistance. Of course, we want to prioritize receiving that grant assistance that was, determined to be necessary to help people keep their homes before you tap in to any of the options that would require you to take on additional debt. USDA loan servicers are strongly encouraged to place the loss mit evaluation on hold and suspend foreclosure actions for any of the circumstances below. The servicer, having received notification that the state HAF program, which is the My Home CT program, that the borrower has applied for My Home CT. Also, in the case of the servicer being notified that the borrower has been approved for My Home CT. So either of those situations, I would also suggest that you call and let your servicer know when you've applied for the program in hopes that they will hold off on a foreclosure. Anything that you can do to stave off a possible foreclosure while you're trying to come current is useful. If you have any questions about your options post-forbearance, or if you believe your servicer has mishandled your mortgage at all, please feel free to contact us at the numbers below. We have translators available in other language upon your request, and you can also schedule a virtual advice session via video conference to talk to one of us attorneys about the specifics of your case. At the Connecticut Fair Housing Center, our mission is to ensure that all people have equal access to housing opportunity in Connecticut that is free from discrimination. So we also help tenants that are experiencing discrimination from their landlord or in the rental process. So if you are experiencing that, please reach out to us and submit a complaint. I hope this has been helpful. Thank you.